there is a shift that started about a year ago in January. Physical markets taking over for pricing and for price discovery. So this was last Friday evening when we saw spot silver actually go above $80 an ounce. So both spot gold and spot silver making new all-time highs. So on Friday evening, they raised the margin to trade to $25,000 per contract, and that was effective yesterday on Monday. It's an additional $5,000. So what that also means is that for those entities that are sitting in those contracts and wanted to maintain it, maybe they had to sell some of those contracts off. Wasn't this a good time to take profits? So that's really what's been happening in these markets.
According to precious metals strategist Lynette Zang, a critical shift in price discovery began about a year ago, with physical markets increasingly driving gold and silver pricing. This transition became evident as spot gold and silver surged to new all-time highs, with silver briefly trading above $80 an ounce. In response to the volatility, futures exchanges raised margin requirements to $25,000 per contract, forcing leveraged traders to reduce positions or take profits. Zhang explains that these margin hikes often trigger short-term pullbacks, not trend reversals. Instead, they signal stress within paper markets as physical demand asserts greater control over precious metal pricing dynamics. Now, we present the clips from Lynette Zang interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Spot gold happened to be up about $54 almost at 43.8617. Spot silver was up $5.37 at that moment, 75.83. And again, nothing goes straight up, nothing goes straight down, always bouncing along the way. Don't believe the Wall Street lies. Just keep accumulating. Be your own central bank, because the reality is if you don't hold it, you don't own it. And you're battling the Federal Reserve, and you're battling the CME and the LBMA and everything else. There is a shift that started about a year ago in January with the physical markets taking over for pricing and for price discovery. So this time actually is different because we are transitioning into a new system. What was happening in 1980? There was the kickoff to the pure debt-based system. What was happening in 2011? We were attempting to recover from the great financial crisis. So both of these things, the CME as well as the central banks, were tasked with controlling what the visible price of gold and silver were. Because as you should be able to see by now, a rising gold price is an indication of a failing currency. And with the devaluation trade, all the talk, that's really what we're looking at. But we can dig into this a little bit more, and I want to do that. Spot silver is on track for its best annual performance since 1951. And let me tell you, it isn't even marginally close to its fundamental value. But I want you to look at these extremes. This is as pertains to the gold contracts, and falls 5% yesterday as traders book profit after rally to record. It is the second time the metal has plunged that much this year. Here they are. I'm doing the circle there and the circle there. So it's easy to do in a paper market, right? Because it's just a contract. Quick and easy to buy, quick and easy to sell. Different kind of reaction in the physical metals markets that takes a minute because it's physical. It's not boop, boop, boop. This is real. That, my friends, is not real. But let's take a look at the spot gold contract, and you can see that even better. And remember, we talked about those 200-day moving averages? Even here's those two drops that I just showed you on the previous chart. But even with the yesterday's, and today it's up again, we'll talk more about that in a second. But even with that 5% correction, we're still over 20% away from that red line, that 200-day moving average. And remember, technically, 10% is a lot. It doesn't mean anything, right? It can stay in a range here. It can go back up. Is it going to, what I really want you to understand is we're talking about easy to buy, sell, and manipulate contracts, unlike the physical. But I want to talk about silver as well, because I know that's where everybody is going anyway. And look at the range. That's what I'm trying to show you. That volatile range just yesterday on spot market. Going back to before 2020, there is nothing like that trading range. So it went up, it went above 80, and then it closed down at 72 and change. And you can see that ginormous range. Let's look at it a little bit more closely in the spot silver chart, because you can see, look at that huge run up in those contracts, right? And then what happened after that? Okay, so it closed at $72.15, which is still 71.6% above that 200-day moving average. Look, I know that it's always more fun when things go up, because psychologically you're going, isn't that great? But I frankly only really watch the spot charts because I know that you do, and I want to help you understand what you're really looking at, because I know it's fiction. Even at $80 an ounce, silver is severely undervalued. Even at $4,400 an ounce, gold is severely undervalued. And the markets, I mean, they're happy. You're not able to find one Wall Street analyst out there that isn't anticipating a banner, at least a kickoff, banner 2026 kickoff in the stock market.
Lynette Zang explains that recent volatility in gold and silver reflects paper market mechanics, not weakness in the physical metals. Spot gold and silver reached new all-time highs before sharp pullbacks driven by profit-taking and contract trading, a process that is easy to manipulate compared to physical ownership. Despite short-term corrections of around 5%, both metals remain far above their 200-day moving averages, confirming strong bullish trends. Zhang emphasizes that physical markets are increasingly taking over price discovery as the global financial system transitions away from debt-based structures. Even at $4,400 gold and $80 silver, both metals remain fundamentally undervalued, reinforcing the long-term accumulation case. Let's get back to the interview.
Of what's happening in silver and gold is also in anticipation of more AI energy facilities, of which they would need silver and copper and gold. Some of that's probably baked in there too. Just keep in mind, nothing goes straight up, nothing goes straight down. It all bounces along the way. And I wanted to remind you of how this really works, because we're going to take a look at what happened during the 2008 financial crisis with spot gold, gold stocks, and the collectible gold coins. Okay, so this is the chart that I created way back then, and you can see that spot gold went down, gold stocks went down. The physical markets, which are different than the paper markets. Now look, this stuff, just this raw piece of gold, is definitely impacted at this point by what happens in those spot markets. But this stuff, they went up and created a new high for this trend cycle in 2008. More than likely, and I don't have that data yet, but when I do, I'll show it to you. More than likely, we have concluded that cup, and now we're going to go to a breakout in this. More about that later as I have it and as I can show you. Because again, on the top, that's spot gold, and that went down. The middle are the gold stocks, and that also went down more than the spot market did, and the bottom is the collectibles. There is a finite amount of the physical. there is an infinite amount of the digital. Your choice. But the reality is if you don't hold it, you don't own it, don't get blinded by Wall Street's lies. Just wherever you are inside of your cycle, keep accumulating. This is from this morning. Metals rebound after plunge from the records. And that happened to be, the time is on the end of that slide. But yes, remember, nothing goes straight up. Nothing goes straight down. You are always going to get bouncing along the way. And as long as you get higher and higher lows, and this is something Mimi has learned, and she's recognized it even in her work as we're tracking what's going on, not even with the markets. If you keep getting higher and higher lows, I guarantee you will get higher highs. And if you keep getting lower and lower highs, I can guarantee you will keep getting lower and lower lows.
Rising gold and silver prices are being driven not only by monetary forces, but also by growing industrial demand tied to AI and energy infrastructure. Expanding data centers and AI facilities require large amounts of silver, copper, and gold, adding long-term pressure to already constrained supply. Historical comparisons to the 2008 financial crisis show a key distinction. While paper prices and mining stocks declined, physical gold and collectibles continued making new highs due to finite supply. This highlights the structural difference between physical metals and digital contracts. Market pullbacks are normal, but as long as metals form higher lows, the trend remains bullish. Physical ownership continues to outperform paper promises over full market cycles. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.